It seems as if we're seeing quite a lot of geographic divergence in terms of the response to this new geopolitical threat, war in Iran. It's been an incredible session in Asia, a lot of negativity, a lot of negative prints on the screen. Is it over, do you think, by any stretch?
I think, first of all, no. The negative impact from the conflict in Iran is not over. And that's because we're just not going to have an easy, full flow of energy from the Middle East for a good while to come. I know there have been promises made, re potential insurance, re potential escorts for boats. That's still going to take, even the most optimistic scenario, that's still a few days away from being implemented, and probably quite a while before we get a full flow of energy. So we've got some sort of energy shock that's still going to feed through to markets. And you've got to remember the context where we've been. It's an incredible day and age. Some of the size and scopes are immense. The worst day for Korean stocks ever. It's the worst. They've only had 2 trading days, and it's already the worst month for Korean stocks since 2008. Quite dramatic. But on the flip side, the stock market in Korea is still up more than 20% year to date. And I think that's the context you got to remember, is that when you look at year to date moves, most assets seem to be doing phenomenally well, which kind of justifies the idea from David Solomon that it's been a benign reaction so far. This does not look like a year where we've had a major multi-nation war fully involved in the US and the Middle East and a sort of energy shock. It looks like overall and year-to-date assets doing pretty well, and that's the context in which you need to see this. So therefore, I think we get much more of a correction across assets over the coming weeks, significantly more, but I don't think that's a sudden, panic-mongering bear market. It's just that, hey, the year has been bizarrely good up until last week, and we've got more of a correction to come.
Mark, in that context, we have gold up today. Bilal Hafiz just told us that it's got further to climb, but you don't agree? I disagree. Now, I think he might be talking in a much longer term horizon. Sure, central banks don't want to buy. Some of the longer term themes are there. But in the short term, and what I mean by the short term, in the next couple of weeks or so, I think gold's got quite a bit of downside. I think there were 3 primary reasons, marginal reasons for buying the dollar recently. One is geopolitical risks. Well done. If you bought for geopolitical risks, you got your big multi-nation war, one of the biggest wars we've seen for some time. Therefore, the trade is run. What more are you expected from now? Just, we've already got full US engagement. We've got multiple nations being struck by missiles. So that trade's run. The other one, if you're doing to diversify away from the dollar, well, we're about to get it. We're in a dollar bull market again now. Maybe not a bull market, it's maybe a bit of a stretch, but we're in a dollar strengthening environment for as long as the conflict lasts. And that will go much further. So you don't want to buy it right now to diversify away from the dollar. And the third one is just the idea that, hey, all these momentum stocks are doing so well, things like the Kospi, etc. So you therefore just pile into all the momentum trades. Well, that one's now blowing up. Just look here, Monitor. That's blown up over the past week. So the 3 primary reasons recently for the last kind of few months of gold have all changed. Dollars reversed, yields reversed, geopolitical thing has run its course, and the momentum trades have blown up. So therefore, I think gold's got quite a bit of downside for the next couple of weeks.